A warm welcome, ladies and gentlemen, to the CNBC Africa IFC debate, which builds on the recently released report, New Horizons in African Finance, Reducing Risk and Mobilizing Capital on a New Scale. Sub-Saharan Africa saw 3.4% growth in 2015. This is according to the World Bank, and is forecast to grow at 4.2% for 2016, moving up to 4.7% 2017-2018. In contrast, advanced economies are growing at a mere 2%, and in that lies a huge competitive advantage. Some context when it comes to capital flows, and here I borrow from the IFC data. Gross capital flows for Africa in 2005 stood at $9 billion. That increased in 2014 to some $49 billion, falling back because of the current economic constraints that we're seeing, reduced liquidity to $40 billion. What we do know is that Africa desperately needs capital for its future growth. Joining me to take this discussion further, to look at reducing risk and mobilizing capital on a new scale, I am joined by Honorable Kebet Gatete, who is the Minister of Finance and Minister of Economic Planning in the Republic of Rwanda. Honorable Abdourahmane Cissé, who is the Minister of Budget, Côte d'Ivoire. Saran Kebet-Koulibaly, who is Vice President of Sustainability and Risk Management at the IFC. Shannon May, who is co-founder, Bridge International Academies. Edward Matthias, who's Managing Director of the Carlyle Group. And Hubert Danso, who is CEO and Vice Chairman of Africa Investor Group. Thank you so much for your time. Minister, if we can start with Rwanda, which has become something of a poster boy for the African investment story, according to the World Economic Forum Competitiveness Report. You are the third most competitive economy on the African continent. Here I refer to data of the 2015-2016 World Economic Competitiveness Report. Let's go straight to the heart of the matter. What financing models are working for Rwanda, and more broadly so for the East African community, which is also leading the charge in Africa when it comes to regionalization?
Yeah, thank you very much, and I'm happy that we are invited for this session that is very, very important, especially at this time when we are looking at new ways of investing in Africa. In Rwanda, and of course the whole of Africa in general, the tradition has been that it is only the government that does the investment by borrowing from any of these international institutions, like the World Bank, the ADB, and others. But this one cannot be sustained because there's a limit to how much you can borrow. Once you go beyond 50% debt to GDP ratio, you are entering a red zone, and definitely there has to be other ways of financing development. We have had traditionally a problem because our capital markets, which usually attract the private money, have not been well developed. And this is one of the ways that we have been addressing in the East African region, especially, where we are trying to link our capital markets to see how the private money can be able to be invested in our own region, and making sure that actually all the rules, regulations are all harmonized within the region so that we can attract the institutional investors, the private investors, and others to invest in Africa. Now, we have reached a level whereby we need to do this even without well-developed capital markets, because we've been relying more heavily on the foreign direct investments. And the foreign direct investments coming to Africa, they come saying, we want to invest, but you need full government guarantees, which becomes a problem because government guarantees is almost equivalent to taking another loan. And this cannot be fully sustainable. Now we are coming up with new models of saying, why can't we co-invest together? Why don't we have the PPP so that we can take on some of the risk and you take also other risk? And at the same time, why don't we bring in other international guarantee agencies, such as MIGA, so that you just simply don't come and rely on government, but you can also attract other international organizations that can take on some of the risks so that we co-invest.
Minister Cissé, let's bring you in here with a West African voice, Côte d'Ivoire. certainly experienced a tough time for most of a decade, 2000 to 2011, with 0% growth as a result of political instability. Come 2011, and the situation changed. You are now looking at strong growth, 8 to 9%, obviously off a low base. But Côte d'Ivoire, and Abidjan particularly, is a focal point for investors looking for growth in West Africa. What financing models are pervasive and working for the Côte d'Ivoire scenario?
Thanks for the question. Thanks for the invitation. It's always a pleasure to be here. I mean, it's always good to have Francophone countries in this kind of forums, because most of the time you're not invited. That being said, since, as you mentioned, since 2011, we have a new president, President Ouattara. So when he came, the first thing that we did was to put together a development plan. So we put a $20 billion development plan that was supposed to be financed both by the private sector and the public sector. We did a lot on the public side. We moved from spending around 15% of the budget in 2010 in infrastructure to something close to a third of the budget in investment. So there was a big change in the structure of the budget to focus on investment to create growth. But we can't do it all by our own. So we need the private sector to come. How do we do that? So we did a lot of different things. One thing was basically to start marketing the country, making sure that people know about Côte d'Ivoire, people know about our growth story. And we did quite well over the past years. We're not at the level of Rwanda, because our ranking in the Doing Business report is not there yet, but we gained 30 seats in 2 years. And for 2 years in a row, we've been among the top 10 reformers in the world. And this is something we really want to continue, because if we really want to attract investors, we need to make sure that the business environment is good enough for people to come. And then there's political risk. And that's something people were looking at. And the 2015 election was a good signal to the investors and to the world by saying everything is fine, everything is back to normal. Now, as financing is concerned, particularly private financing, we looking at PPPs. We did a couple of transactions. We did one on the third bridge of Abidjan, which is a toll bridge that was put together, and that's been open since 2014. There is Azito, which is another deal where IFC was actually involved, whereby we look at sharing the risk. But there's still challenges that we need to overcome. One big challenge is human resource, because if you want a deal to get done, you need to have good human resources. You need to have good legal framework. And you also need to have projects that are mature enough and well-structured. And how do you do that? So something that we decided to do was to put in the budget every year at least $40 to $50 million in order to finance feasibility studies, to have projects that are actually bankable for the future. So these are basically the different steps that we're putting on. But the world is changing. There's big competition. We have to make sure that we're on top when investors look at Africa.
Is it true that you can open a business in 24 hours in Abidjan?
Yes, you can do it in 24 hours, and we actually reduced the creation cost of companies by more than 70%.
Minister Gatete, they actually really are hot on your heels.
But I think the points that she is raising also are the same, almost, when he's talking about doing the feasibility studies ahead of time. This helps in terms of actually the investment coming in ahead of time. Of course, one of the things that is common to all our countries is having the macroeconomic stability, because the people who are investing, they don't want the currencies that keep changing. So the macroeconomic stability becomes very important. And of course, the conducive business environment that you was mentioning is almost similar to most countries. And that's why for Rwanda it has worked.
So Sahan, let's bring you in here and the trends that we can extrapolate from the East African voice and the West African voice. World Bank saying that private-public partnerships are definitely one of the better models when it comes to financing long-term infrastructure deals. Minister Cisse has mentioned the Azito 3 power project in Côte d'Ivoire. And we're going to go into that in a little more detail as a case study. But perhaps just if you can weigh in from an IFC perspective on sustainable trends. It's interesting whether you can deploy the same trends across regions, across countries, or in some instances, has it got to be specifically crafted for each deal?
Thank you. Before maybe addressing your question directly, I think it's very important that I pick up on a couple of things that both Minister Gatete and Minister Cissé mentioned. And that is about the environment. Creating an environment where you attract the private sector, where you create a level playing field, is extremely important. So obviously it's not by chance that both Rwanda and Côte d'Ivoire are attracting private sector investment because they have put in place reform, structural reform, opened up sectors to the private sector that allow that to happen. Otherwise, there is a lot of money, liquidity across the world that is trying to find a home, but they need to be landing in a place where actually the private sector can operate with a level playing field. So having said that, I think you're absolutely right. There are, the financing is different depending on the country, whether they've reformed, they're in process of reform, or have not at all reformed, but as well on the project by project case. We in IFC really focus on trying to bring structured solutions, creative solutions, and financing together in terms of also working with our counterparts in the countries and with the World Bank to make sure that all of the sides come together. And in this context, maybe Minister Cissé has mentioned the Azito project. Azito actually is part of a 20-year engagement of the World Bank Group, and particularly IFC, in Côte d'Ivoire, on the back of sector reforms that allowed the private sector to come in. And it led essentially to putting in financing of over $1 billion in that sector, and more than doubling the capacity of the power sector. So it's a good example of a public-private partnership that is absolutely critical in terms of mobilizing financing, but it's also highlight the importance of a power sector in Africa. According to certain estimates, if there were universal power access in Africa, the growth rate that you've just mentioned would be doubled in the future. So the leverage there is absolutely critical. In addition, we've done fairly creative things in the capital market area of opening it up for domestic private companies, enabling them to borrow locally and then avoiding foreign exchange risk, for example. And one such example is a bridge Bayport financing in Zambia, which allowed a microfinance institution to lift funding from the domestic capital markets and fund small businesses and middle-income people.
So, thank you very much for that. And you've also touched on lack of access to electricity. The stat out there, according to McKinsey & Co., is that 600 million people in Africa do not have access to electricity, and that's a 2015 report. Electrification, and just having recently been to Abidjan, it struck me when I drove in on the highway in the evening that there are electronic billboards in Abidjan, so that power plant certainly visible to someone who travels the African continent on a regular basis. Shannon, let's bring you in. And to throw around another stat, there are according to the World Bank, 50 million children in Africa do not have access to education, to schools. And I hope your website is correct, because you seem to be growing so fast, the numbers could be outdated. What I've got is that right now you have 400 schools across Africa servicing some 100,000 students. You're wanting to grow, and it's a very, very ambitious target, by 2025 to educating, and this is in the primary and pre-primary space, 1 million children in developing economies. So not exclusively in Africa, but also in Asia. Is your website up to date? And my second question is that you present a very good model of blended finance, and I'm going to allow you to explain exactly what that is.
Well, our website's close to up to date. 461 open nursery schools and primary schools across both East and West Africa. We began in Kenya, expanded to Uganda, Nigeria, and very shortly in Andhra Pradesh in India. Our focus, as you said, is to serve children with truly high-quality education, wherever that might be needed. And over the years that we've been doing this, looking at different finance models has been incredibly important, both to enable us to scale, to do the investments that we need in technology-enabled services and teacher support methods, as well as working with different nations and the different syllabi. So we've had an opportunity to work in what's now being called blended finance, where you're able to access some amount of concessional capital that allows risk to be distributed in a more appropriate way between different financial partners. And so in our first experience with that, we were being asked by DFID, which was looking at how to improve education outcomes across Nigeria, where they've had a long focus as a development finance institution. But at the time, it was a very risky place to enter. They were looking for various innovative business models who would come in and work hand in hand with the government, but work as a private sector entity, opening up new nursery and primary schools and really trying to push the market to increase the quality of provision as well as increase access. So they put out a bid, people applied. We were able to succeed against that bid and to secure a bit of concessional capital, which enabled us to later on crowd in private investment. Whereas as we were moving into, at the time it was 2014, it was before the most recent election, there was a lot of instability around the currency. It wasn't a time where a significant commercial capital was ready to look at.
So break down concessional capital for the audience.
So concessional capital simply is capital that is a grant to
philanthropic capital.
Philanthropic. It's not debt, it's not paid back. It enables usually a very specific development goal to happen. You could think of it as, for decades there's been capital that helps support work in the sector, whether it's in health or education or infrastructure, which is not structured as debt or equity, but is philanthropic. It is a grant to the government or an institution to operate. And in this case, given our proven development outcomes, that we're a private operating partner, but we have proven development outcomes for children in nursery and primary school, showing how that they can learn more compared to what else is happening in the neighborhood. And so that was very attractive to a development finance institution that's looking for measured outcomes. As we move more and more to talking about pay for success, pay for results, even looking towards relatively new financial instruments like a development impact bond, that operating entities that can prove delivery of service and are happy to be measured by it, whether it's in health, education, agriculture, that these are sectors, particularly in Africa and the emerging markets, that need more capital crowded into them. Commercial capital has a different risk profile.
Edward, let's bring you in here from a Carlyle Group perspective. I was watching an interview in 2013 where you were speaking about your fund of, at that stage you were talking about $600 million, but you corrected me a short while ago and said it's now $675 million. And the point that you made, which really resonated with me, because a minute ago I was telling you about the high growth figures in Africa. The point you made is that there have been many, many academic studies that GDP growth does not necessarily translate into high investment returns. It's about the price that you pay for the company and whether that company itself can grow. So tell us about your African experience, sir.
Good. Briefly, we're a global investment firm. I wouldn't say we qualify as having a philanthropic approach. I mean, we're not against that, but we're basically looking for investment returns. As a firm, it's very important for us to have a strategic foothold in Africa. I mean, everybody's aware of the demographics, the rise of the middle class, the growth of the economy. So that, for us, is a strategic imperative. Personally, I've been quite involved in Africa through Power Africa, where I've served on a partnership committee with USAID, and I was on the President's Council for Doing Business in Africa, where we just made a trip to Rwanda and to Nigeria, the idea being the US government trying to be an interface between Africa and the US business community, and we've made quite a bit of progress there. I'll just mention 3 or 4 quick things. Raising money in the US for Africa is not easy. We're very early in the process. We found much more interest among families and high net worth individuals than we did in institutions. So it's still quite early for institutional commitments. Secondly, the opportunities there, you have to almost divide them into 2 categories. One is what I would call the infrastructure, the large projects, which basically the private sector cannot finance. I mean, you're really going to need government intervention, support, risk mitigation, et cetera. And they just don't qualify based on the duration, the characteristics of the deal, returns. We are starting to see globally some infrastructure funds formed that will do this type of thing. What we have found in terms of the opportunities is that we can't transport the US model of private equity to Africa. The real opportunities at this stage are in the smaller companies, the growth situations, what might be called, one step up from venture capital, and also the need for debt. I mean, in some ways, debt financing is almost attractive as equity, and it's becoming more pronounced given the pressure the banks are under. Our experience has been a learning and difficult situation exacerbated by 1, the currency, and 2, the commodity price change. So we've gone very slowly. We still see a lot of opportunities there, but has been a very challenging environment. And then when you layer that across dealing with 47 or 54 countries, for private equity in our situation, there's only 5 or 6 countries that today really lend themselves to our entry.
Hubert, let's come in from an African investor group perspective. Deal making across the African continent is something you spend a lot of time doing. The trends that you are deploying.
Well, I think one of the most important things, first of all, is to recognize that the continent has got a long history of governments to DFIs and governments to donors. And our client base and our partner network is predominantly pension and institutional investors and insurance companies who are really just trying to diversify and get access to opportunities on the continent. But with that comes access to large pools of capital, but the risk is very thin and very tight, and the levels of governance that they expect and the types of opportunities that they can access are very, very limited. And of course, they're very clued in terms of the global media outlook, in terms of all of the headwinds that we know the continent continues to get caught up in because of the global economic trends. So it's really important to understand when you're engaging institutional investors, it's a very different conversation than when you're engaging sort of concessional capital, development finance institutions, and the other. But that being said, we're seeing a number of different types of models that are coming to market, and there's a real sort of flight to quality. In other words, these institutions are really trying to figure out a way to concentrate their access to the opportunities so that they can actually look at them as financial risks as opposed to project risks. So they really want to go in behind very specific platforms where they may say, okay, we want to get access to, let's say, the oil and gas sector in West Africa. We're going to allocate some capital to do that. Do we need to go in through 5 different investments with 5 different companies? No, they're saying rather, let's back one big player that's very credible. Let's use that company to actually integrate our own strategy and get access to that sector and get access to that geography. And we're seeing that in education, healthcare, oil and gas. So it's a platform strategy that seems to be manifesting itself. We're also seeing something similar in terms of the capital markets through the increasing interest, and we're working on a couple now, of SPACs, the special purpose acquisition companies that are actually going in through the capital markets as listed instruments to get very focused access to sectoral and geographic opportunities. And we're seeing that in banking, we're seeing that in renewable energy, we're seeing that in other infrastructure subclasses. And there's also the view in terms of, and I know you want to move on just slightly, but I think just to Ed's point, I think the way that we classify the institutional investors and their appetites is really important, because we're seeing a lot of co-investment strategies through small investments into private equity to get a foothold, to get access to genuine co-investment opportunities on the ground. And lastly, early stage capital for infrastructure, typically being the preserve of development finance institutions and or governments who provide, as the ministers have pointed out earlier, their own finance to do technical assistance. We're now seeing construction companies, civil and consulting engineering companies put aside, say, little pots of $30 to $50 million to actually provide early stage equity or developer loans so that they can participate in the same projects down the line. And private equity companies are also exacerbating that model by actually acquiring developers now. So there's new forms and new models of actually being able to invest in some of the more riskier, earlier stage types of opportunities on the continent.
So Hubert, you are igniting debate. Sarhan has said she would like to come in, so has Edward. So Edward, I know the point was made. If you can go in, sir, and then Sarhan, if you can take us back earlier.
There's two areas that are going to make a huge difference initially. One is infrastructure. It is very difficult to do business. So attracting infrastructure capital is just extraordinarily important, and that will beget success. The second is attract corporations. Major corporations have a real incentive to have a presence here. They will not initially be economically driven. It will be strategic. And that's one thing the President's Council's been trying to do, but I know a lot of the African organizations, the governments are doing the same. So when you get Coca-Cola, Caterpillar, Deere, others building plants, that will beget business, and then there will be much more investment opportunities.
Infrastructure, is that what ignited you?
Yes, indeed. I think I wanted to make a similar point as Ed just made. And I think in the current context, what is happening is not really surprising, because most private sector tend to focus on the smaller projects because they have more visibility on those ones. But infrastructure is absolutely critical. And for that to happen, it goes back to the comments I was making earlier, that the need to create a sector of reform where private sector can come and we can crowd in the private sector financing. And this is where it is important, because the risks are high, regulatory risks are high, but even the perception of risk is even higher. Because people just don't know the environment and cannot predict, do not have that visibility. And that's where I think institutions like IFC come in. Both of you mentioned on a couple of occasions, institutional investors. This is not yet where the interest in Africa is not there yet. But there is a possibility, actually, through the risk mitigation that multilateral institutions like IFC have to mitigate some of the risk, and creating actually new products that are in new asset classes through structured finance, and creating products that are investment grade, vehicles through which they can invest in infrastructure. Because without that, it will be difficult to bring in financing to Africa in the scale that is needed. It will still remain the smaller size projects, and infrastructure, nothing will happen without that infrastructure being in place.
Minister Gatete, we're coming to our currency volatility question, but Minister Cisse wanted to come in again, yeah. I'm assuming on infrastructure.
Same thing on infrastructure. I mean, it's really key, because at the end of the day, what government is trying to do is to improve the quality of life of the population. So we need to make sure that we give basic access to the population, and we need to give them jobs. Because if you take a country like Cote d'Ivoire, demography transition is key. We basically have around 77% of the population that is less than 35 years old. So we need to find them jobs. So we need big infrastructure projects. If you take electricity, for example, we've been growing at around 9% per annum every year. When you grow, it basically means also that your demand for electricity grows at the same time. And for the past 4 years, we managed to increase our capacity by around 38%. We basically now have around 2,000 megawatt of capacity. That is actually half of the capacity of Nigeria, when we only have 24 million inhabitants. So there's a lot of things going on. We just closed a few weeks ago a deal with Endeavor. It's a $900 million deal to build a 375 megawatt capacity in Cote d'Ivoire. So infrastructure is key. We try to do it on the budget by allocating a decent size, but we can't do it all by ourselves. And experience is actually also important. We did a couple of deals where we did give a lot of guarantees to people, like PPAs. We did some revenues guarantee. We won't continue to do that forever, but we had to do it for the deals to happen.
So I think what I'm going to do is that the debate has been hijacked slightly in that let's focus on infrastructure financing. And we've got another 30 minutes to take this discussion to some conclusion. I like to find something that we can get our teeth into rather than flitting all over the place and having half-hearted discussion. So let's focus on infrastructure. But Minister, I'm still going to get my currency volatility question in there because Edward said it is a key risk. And even if we are financing these large multi-year infrastructure projects, people cannot plan, investors cannot plan if there is currency volatility. So what is the solution there? And let's do it in the infrastructure context.
In this period, we are having several problems which are affecting all of us. One is the decline in the GDP growth by China. It has been a big consumer of our commodities. And now when the economy declines, last year 6.9, and now it's coming down to 6.5. And once it declines, meaning that actually all our exports, also in terms of commodities, are also being affected, especially minerals. At the same time, the European region has not really recovered completely, given the previous debt crisis, the issues that they have been having, and it hasn't come up as strong as we expected. But also United States, which has been the pusher, and that one is coming to the currency. After pumping in 3 trillion in quantitative easing and now retracting and saying that we are going to raise the interest rate, means actually the money that was being pumped in the whole system is no longer reaching our own region. And that's why for the African countries going in the market now to issue a Euro bond, it's very expensive. Now it's almost close to 10% or slightly above 10%.
So can we mitigate against the risks?
But now with the increase in the currency, which is affecting all the others, that's where the key focus is really what do we do to increase our exports? What do we do to make sure that some of the products that we have been importing can be produced in our own region? And what should we do so that we have the regional integration so that it becomes the buffer of all the markets? And that's what we are doing in Rwanda here. We are focusing heavily into the export promotion. We've now established not only the special economic zone, but also industrial parks, which are mainly focused on the exports. We put a fund, which is export growth fund, that is helping the exporters. We are adding value to almost every commodity that we are exporting abroad, and we are providing fiscal incentives and other incentives to make sure that this area can be able to expand. This is the only way you can sustain it, because you need to make sure that you export and be able to sustain the foreign currency requirement that is needed for all the importers.
Minister Shannon there is indicating she wants to come in, but I do want to make a point on what you're saying on the manufacturing side, and it brings back to Minister Cisse. Shannon, I'm coming to you. That is, you're the #1 exporter of cocoa in Cote d'Ivoire, but you are beneficiating. You've just deployed a factory, you're making chocolate. Exactly. So that goes to the point that you're all moving in the right direction and taking advantage of currency.
Completely.
Shannon, coming to you.
If I may add, on the currency side and also on commodities, every country in Africa is different. So for example, the drop in commodities prices, it's good for some importing, like oil importing countries. And overall, if you take everything aside, if you take, for example, Cote d'Ivoire, our currency is pegged to euro. So it's kind of like, if you invest in Cote d'Ivoire, it's a euro type of trade that you're actually doing. And macroeconomic stability is key, as the minister mentioned. So every country has to make sure that they have a strong macroeconomic fundamentals and a story to sell in order to attract investment into the countries. But value-added product is definitely the area where we're all heading to, and regional integration too.
So Shannon, I'm assuming you're going to bring us back to infrastructure and how key it is to education, because you are leapfrogging in that space with digital technology. So we can play catch up to advanced economies, and I think you've got a very good example. Am I preempting what you're saying?
Very close to it, Bronwyn. So I wanted to challenge Ed's comment that the two most important things were investing in infrastructure and bringing over large multinational companies. Before we can do that, We have to invest in social infrastructure before you can do value-added businesses in your own country to increase your GDP. The single most important thing to do is to invest in basic education. A common mistake that is often made is investing only in elite education. So investing in a few schools, a few model schools, or allowing a few elite private schools to exist.
I'm going to come in here because I think that the starting point is still the electricity, the energy, because that is what is going to change the education equation. Without it, you're not going to be able to roll out that soft infrastructure or play catch up on the education deficit.
You have to have both, but if you ignore
What comes
structuring
first?
investments...
What comes first?
These things aren't mutually exclusive. I think education and the social, these are what I call long, slow ideas. But then you look at what are the big levers you can pull that make a difference short term, and it really gets down to infrastructure and economic activity. Because if you have that, and I know these things are interrelated, but that really creates the environment where you start to have jobs, you start to need educated people, you start to have the resources to pay for that. And let me throw out an idea that has multidimensional. First of all, the world is looking for returns today with negative interest rates, with the stock market muted. So nations or a continent that can provide high returns or the potential for high returns is very attractive. The fixed income markets for AAA and DFI investors are basically giving money away. You pay no interest, certainly based on inflation. To kind of raise money and to use that to create sort of the type of things we're talking about, provide risk mitigation. If you can get the greenfield early stage projects done, money will come in for assured rate of return. It'll be a different kind of money than you might expect, but there are people searching the world for return that's somewhat assured. So I come back to, I don't think these are mutually exclusive, but I think you have to.
So I just want to ask a question then to Shannon, in that you've made big, going back to your website, you make reference to that digital technology. If you do not have power, you cannot charge that technology to deploy your education solution. I'm just trying to find a starting point here. I don't know whether you can tell me that you can do it without solar energy or electricity, because I want one of those devices.
Yeah, so we do need energy. Power Africa is very important. But I think it's important to think about the exact uses of different pieces of infrastructure, what you're trying to really populate investment with. So for example, for us to run really effective schools, we do piggyback off of a couple things that if they don't exist, we couldn't run nearly as effective a school. So one is energy. We have to charge tablets and phones and devices. We do that sometimes by solar, sometimes by wind, sometimes by the grid. But not a single one of the 461 schools we operate actually has electricity connected to the school itself. We leverage off of kiosks and other institutions and entities in the communities. And then really important for us, and it's important for lots of businesses developing across the continent that actually work with the majority of the population living below $2 a day, is the cellular networks, which are incredibly important. And as we're starting to look expanding across parts of West Africa that don't have as much penetration on the cellular networks, that's a real issue that we're working with various governments on how to develop in parallel the cellular networks and education outreach services.
So I want to talk about that because we've got to bring it back to the financing, and let's use this infrastructure as a starting point. Blended finance we've chatted about, philanthropic and commercial capital. We've looked at public-private partnerships as being a very good anchor point for your infrastructure projects, for your multi-year infrastructure projects. Can I throw something in the mix here? Does Inga Dam resonate with anybody? Because I'm thinking if we've got a number of players, as we have here on the panel, cooperation and getting a project like Inga Dam, also, and I may be wrong, Minister Gatete, can I throw it to you?
Sure.
We're looking for a starting point.
Mm-hmm. Well, the Inga Dam has been there since I think I was born. We've been talking about Inga Dam powering the entire African continent, but we have not started up to now. I think we are still talking about it. And I think it goes back to, first of all, the structuring. How do you take on the entire Inga Dam all at once? How do you mobilize resources all at once? How many countries should be involved? How many companies should be involved? So if you don't break it into bits that can be chewed by the investors, then it becomes very difficult, and it remains there as a white elephant. So what we are saying is that there are many options. One is working within the regional communities, and that one helps. And that's what we've seen, for example, in the West Africa power pool. That's what we are doing in the East Africa, going in as a region, rather than individual country, looking for many investors, and maybe the environment also is not correct. It's like, how do you structure it in such a way that people are interested? And that's why the region becomes now very, very important when it comes to investment, especially when it comes to infrastructure, including energy, including cross-border infrastructure, other infrastructure projects like the railway that we are doing within the East African community. So Inga Dam is a very good project, but it has to be structured in such a way that it can attract investors.
So Sarah, let me bring you in here. Perhaps now, as Minister Gatete points out, that we're moving to regional projects that are being financed by investors and by different forms of investment capital. Maybe the mothership of all investments, we can ultimately build that regional to a play where Inga Dam doesn't look that complicated anymore, and everybody can come around the table. What, from a development finance institution perspective, can you throw in the pot here?
Well, look, let me say, I think that project, we tend to focus a lot on the huge projects. Inga Dam, I think, would certainly cover the needs, the power needs of, of Africa. But I think Minister Gatete was also saying it's important to break in different pieces. Because the complexity of such projects are very difficult and basically tend to discourage people to advance. I actually believe, and I may not be answering your question very directly, that there are a host of other smaller projects which could have as much impact as well when you take them collectively. And there is disruptive technology happening, for example, in certain spaces like the solar energy currently. I mean, I was hearing last week that the Mexican government was able to bid out solar projects for 4 to 5 cents a kilowatt hour. That's never heard of. So there's really technological advances that are happening that can provide local solutions to the power problem. And of course, working on bigger size projects on a regional basis. The West Africa Power Pool, it's been there for a while as well, but has not been fully functioning as well because of lack of natural gas and coming from Nigeria, where if there were reforms in the sector increasing the price of natural gas for alternative uses, then you would see natural gas flowing into power generation. So there are intermediate solutions. I think
I think that I'm taking a cue from both you and Minister Gatete. Rather, let's talk about regionalization, regional power pools. I'll park Inga. I won't bring it up again. Edward, you want to come into the fray here, sir?
This is going to be perhaps related about regionalization, but one thing that countries need and regions need and continents need are strong capital markets. You need breadth, depth, regulation, and that is sorely lacking. So maybe some kind of regional market. I know Rwanda, other countries have raised money outside, but you really need good capital markets to foster economic activity, and that's particularly important now because of the pressure the banks are under.
Right, so Hubert, you've got a comment, and then I have to move to closing comments. I can't believe that we are almost out of time. So yes, you've got a double hit at this. You can go and then you're going to come back again at the end.
All right, very good. Now I'm just picking up on Ed's point about the capital markets, and if we are really serious about reducing the risks and sort of crowding in this institutional capital, we've really got to be much more serious than paying lip service to capital market development. We've got to come up with very practical instruments that are capable of de-risking. So for example, I sit on the Continental Business Network, which advises a number of African heads of state who are looking at very practical risk mitigation style instruments. And one of them is how can we take African projects, but principally African infrastructure projects, and wrap them and then ensure that they can actually gain better access to institutional insurance and global pools of capital, as well as the domestic pension fund pools. So the types of instruments that the IFC and others can really assist with is some of the bond type models where, for example, one of the concrete outcomes is a senior, fully secured debt instrument that can be issued by an insurance company with no concentration risk, AAA rated, BBB returns, regulated by the likes of Insolvency II, which is fully secured globally anywhere in the world. That's capable of happening right now today on African projects. But I think until we begin to look at the capital markets, the infrastructure around the capital markets, and improving the governance in the investment management industry, we're probably missing an opportunity, a very big opportunity.
It's a very big discussion, and certainly 1 hour is not enough time to do it justice, but your input is very, very valuable, and this is why I'm going to throw it back to you to the conclusion. So I'm going to put the statement that we started with out there, is that today we were going to be looking at reducing risk and mobilizing capital on a new scale. So you can choose either of those sides of the topic, Minister Gatete, and give me your closing comment in a tangible solution for either reducing risk or mobilizing capital on a new scale. Over to you, sir.
Thank you very much. Well, the two go together. You have to reduce the risk, and that's why we need macroeconomic stability. That's why we need business conducive environment. And that's why we need to work within the regional context and making sure that we really, there is also the sharing of the risk between the government, the private sector, and also the international institutions that take care of the risk. That's very, very important. But at the same time, I wanted just to emphasize one point that our colleague just mentioned. You can't, no matter what you do, you can't continuously sustain the attraction of the resources without building the capital market. This is the basis for anything. And since our countries sometimes have very small capital markets, it's always good to look at it within the regional context. And this way, then, there's more resources that can be attracted if also the conducive environment that attracts the business community is also very favorable. But in as much as we are doing everything that we need to do, without a capital market, it can't work. And that's the long-term way of sustaining the attraction of the resources in our own countries and regions.
The bottom line, depth and breadth of local capital markets. Exactly. Minister Cisse.
I'll go in the same direction. We basically need to know what the challenges are. Financing is one of the challenges. It's really difficult to get access to concessional financing. So we need to make sure that the private sector comes in. For that to happen, we need political stability, good governance, good business environments, and we also need to make sure that we have the adequate human resources. To speak about what was earlier mentioned about education. Education is key. It's a long-term investment, but you basically need to have it. If you don't have it, your project won't be structured enough, and no one will come to look at it. And we also need early-stage financing. Either it's coming from donors or coming straight from the government. In Côte d'Ivoire, that's basically what we do.
Is that to drive the SME environment?
Drive SMEs and drive even projects. And it's really key and really important to have that. Regional integration is important. Value-added product is also important, but financing is key. And it's actually the thing that we want to fix in the near term.
Sarah.
Well, I think maybe I will flip it around a little bit. I think, as I've been saying from the beginning, having the right environment to attract the private sector is the most important. I think money is a commodity, and there is a lot of it that is circulating globally. With lower interest rate environment and even negative interest rate environment, I think Africa would place itself in a very good situation by really capitalizing on that, offering higher returns by attracting private sector to the sector, to its economies. I think that social infrastructure, absolutely, we need to work on that, capital market development as well. But physical infrastructure development trumps it all, because that is the basic foundation on which we can build our
physical infrastructure development.
Yes, physical infrastructure development. And I think the role of institutions like IFC is really providing mitigation for a number of risks, both for projects to happen, and attracting institutional investor. I think we can structure around a number of products, creating new asset classes, but the sine qua non has to be that the environment is conducive for private sector to come and play.
So Shannon, I also want to commend you on the fact that your schools don't have electricity and that you are utilizing regional town resources, I'm assuming, whether it's solar or renewable. So let's hand it to you to give us your thoughts on the topic at hand.
Thank you, Bronwyn. It's really important to think about crowding in investment. So I know that we spoke a bit about blended finance, how you could get philanthropic capital to take a different risk profile than commercial capital and try to combine them. We've also had experience in working with IFC and seeing what the IFC can do as a lead financer across Africa. Many venture capitalists and private equity firms are relatively new to the space. They're interested, they see possibility, they're looking for deal flow, but many of them don't have decades of deep due diligence on the markets, on the capital markets, the regulatory markets, or on these operating entities. So in our experience, in our last round, which was led by the IFC, it was the very in-depth due diligence the IFC did that then enabled the CDC and other DFI of the UK to follow on, but then gave confidence to commercial investors because they were able to then see the work that IFC had done. And so when you have those types of co-financing, you have entities that have strong relationships on the ground, able to find the entities that are worth investing in, that could contribute to both physical and social infrastructure going forward. And I think it's really important that we think strategically and creatively about how to distribute risk, and that will crowd in more commercial capital.
Edward.
I think there's no doubt that the continent has hit some headwinds here short term, which are going to push out some of the growth prospects. Currency, political instability, dependence on natural resource, some other problems when doing business there. But I think we've touched on what the major issues, and they're all large, they're structural. Infrastructure, reasonable budgets that are dependent on slightly lower oil prices, less dependence on natural resource and development of financial markets, and more of a regionalization kind of approach, which will make it much easier to do business in Africa.
Hubert.
Well, I think there are two things I'd like to touch on in closing. We know about 2.5, this is the projected number, $2.5 trillion is going to be required each year to pursue the Sustainable Development Goals. And a large part of that, or a significant portion, is going to be Africa related. So we need to think much bigger if we're going to be serious about really trying to make a dent in development on the continent. And it's probably the types of instruments that can access those larger pools of capital, recognize how best to access the domestic pools, the pension and the sovereign wealth fund capital is going to be critical. But ultimately, these institutional investors that can actually help get us to that point, in partnership with all the other key stakeholders and players, are ultimately going to need to be able to allocate to institutions that are transparent, that they can trust, that the governance is in place. So a pension fund will allocate to an asset manager, fund manager, and we really need to think about how to create almost like a Power Africa scale, an Africa 50 scale, a global infrastructure facility scale approach to risk in Africa, because we lose more money each year by not properly addressing and quantifying the risk that's lost than any other sector that we seem to be focusing on. I think that's where we need to focus.
Thank you very much for your esteemed opinions. Thank you for being such an attentive audience. And that brings us to the close on the CNBC Africa IFC debate on New Horizons in African Finance.